If you are applying for a home loan, you may have heard the term debt-to-income ratio, or DTI. So what's a debt-to-income ratio and why does it matter so much if you are getting a home loan? In this video, we'll explain what debt-to-income is and why lenders care so much about it. Your debt-to-income ratio is all your monthly debt payments divided by your gross monthly income. This number is one way lenders measure your ability to manage the monthly payments to repay the money you plan to borrow. To calculate your debt-to-income ratio, you add up all your monthly debt payments and divide them by your gross monthly income. Your gross monthly income is generally the amount of money you have earned before your taxes and other deductions are taken out. For example, if you pay $1,500 a month for your mortgage and another $100 a month for auto loan and $400 for the rest of your debts, your monthly debt payments are $2,000, and if your gross monthly income is $6,000, then your debt-to-income ratio is 33%. Fannie Mae and Freddie Mac, the backers of conventional loans, have approval guidelines that address the risk that borrowers with a higher debt-to-income ratio are more likely to run into trouble making monthly payments. The debt-to-income ratio is important because it makes sure that the housing costs relative to income meet standards and you have leftover funds to cover all of your other monthly expenses. What is a good DTI ratio? A good target for a DTI is about 1/3 or so of your income. But you can qualify for a mortgage with a higher DTI, up to 43% for most loans, and maybe a little higher for a conventional loan. The requirement will vary by the lender and type of mortgage. Ideally, though, you'll want to keep your DTI as low as possible, regardless of lender's limits. Paying down debt will help improve your credit score, and a higher score and lower DTI will help you get a better mortgage interest rate. DTI isn't a full measure of affordability. Although your DTI ratio is important when getting a mortgage, the number doesn't tell the whole story about what you can afford. DTIs don't take into account expenses such as food, healthcare, insurance, utilities, gas, and entertainment, and income taxes. The loan is based on your taxable income, not what you take home each month. You'll want to budget beyond what your DTI labels as affordable and consider all your expenses compared with your actual take-home income. If your DTI is high, keep in mind an acceptable debt-to-income ratio is unique to you. A household income making $75,000 a year with 43% of their income going towards housing is in a different spot than a household making $200,000 a year and 40% of their income going towards housing. Pay off debt to avoid taking on more debt Credit card and installment debt is included as part of your total debt payments, and attention to running up your credit card bill or buying or leasing a car when you're considering buying a home is important. To lower your debt-to-income ratio, pay off the debt you have. A $10,000 balance on a credit card is much different than a $10,000 balance on a car loan that has a much longer prepayment or loan payment term. Be strategic. Sometimes using funds that you have saved for a down payment can be applied to reduce your outstanding credit card bills and lower your debt to income. That's because a slightly higher mortgage is typically amortized over a much longer period of time, so it will help you qualify. Any questions with respect to qualifying for a mortgage? That's what I do. You can reach me down. Contact information is down below. Thanks so much.